everybody. Thanks a lot for joining us at this Wednesday afternoon market recap. A lot has happened, obviously, since that last recap, which I posted on Monday afternoon. It was when the markets themselves collectively gapped down to the upside. However, they did present us with that of a white candlestick, sort of a continuation type of candlestick. I mean, it was leading us to believe that we may be setting up that of a stair-step continuation type of pattern. Now, of course, rewind, fast forward to yesterday's session. That's when essentially the very short-term, absolutely short-term bottom somewhat fell out of the market. We did see the markets down about 1.5%. It was a long day, sort of dark Morobozu. We do have a little bit of a wick holding up at support, and today's candlestick is sort of an inside day candle. Not so much inside the real body on the S&P 500 of Tuesday's candlestick, but we were contained within the price action on Tuesday, down another 4.5 points, give or take. Really, at the moment, these markets collectively, so to speak, they're sitting on their 50-day rising exponential moving averages. And in the past, this is where we have seen buying support show up. And again, I've sort of floated this idea as well. And that is on the Dow Jones Industrial Average was, well, if we weren't in that of a stair-step consolidation, like a short-term continuation pattern, then we may be in that of a very early stage of a bull flag. And I mean, this is still potentially a possibility as to what is under construction currently at the moment. However, again, when I flick on over into these oscillating indicators, you can see very firmly that they have flipped from supporting, right, higher prices into that of a correction. The question really becomes at this particular time is how deep is that correction going to run? And more or less, is there a potential or is there a likelihood even that we've already run through the correction down to this rising 50-day exponential moving average? I'll show you it again on the Dow Jones Industrial Average. You can see that we're resting right on this 50-day exponential moving average. We are slightly, ever so, just below it. And again, when I show you the NASDAQ, we're actually still above it. So, I mean, there's a lot of sort of fear out there at the moment. A lot of people sort of lose their minds a little bit when they do see the market sell off, or at least, even if you see a short-term, relatively short-term capitulation below that of a temporary sort of basing pattern. And it makes them immediately want to sell their positions, right? So more or less close out any open positions and also to actually short the market. And I still feel, and the technical analysis suggests that we are still moving to higher prices. What is going to be interesting is to see whether or not we do see a reaction off from this rising 50-day. I'm just going to sort of hypothetically draw where that 50-day moving average is. Whether or not we see a reaction off from this, and also if we are to see a reaction off from this, it doesn't necessarily have to touch it. It can show up more or less from where it is now all the way down to the 50. And whether or not we see this commodity channel index turn back up above 100. If you see that, that again is another major warning signal that this market is just buying time before it actually breaks above its all-time highs. Now, again, when it comes to the correction, I've had a lot of emails already about people talking about, well, where are these support areas? Where are the logical areas whereby the markets would slow down? And really the best way to show you this outside of the traditional, right, horizontal support and resistance is to come here and to show you it using the Fibonacci tool. So again, I'm using that specific candlestick to draw off from. And I'm going to end it on this long white day Morobozu candlestick here. So I'm using this candle to conclude it. And this is going to be the range. The reason why is because this candlestick here is where the handbrake, so to speak, was pulled on the market. And since then, we have been in about a week's worth of falling prices, okay? More recently, that certainly being Tuesday and to a lesser extent today. But if you look at the range bound, or at least the Fibonacci retracement ratios over here, 0.382, 0.5, and 0.618, you're looking at figures down here at 2,728, 2,658, and then the 61.8% retracement, if I can zoom on in a little bit, and I'll have to remove my drawing tool. It's all the way down here at 2,588. Now, I've already done this, and I've looked for Fibonacci confluence, measuring off different waves. But again, these are the true waves here. The first beginning of the sentence, or at least the ending, if you're actually using the Fib tool. And that is the beginning of the sentence where the handbrake has been pulled on this upward trend. So again, it's too early to say definitively whether or not we are going to actually leg into sort of a Fibonacci retest down at these lower areas. I would suggest that it would be, I mean, there's two ways to look at the market if it does actually move into this type of correction. One, you can essentially panic, sell some of your holdings. I mean, that would be unfortunately what the majority do. Otherwise, you can find yourself in the minority, which would be simply to jump on in down here, add to originally existing long trades. This is only going to be a temporary sort of retracement if it does get all the way back down here But I want you to realize that the end result of this market, whether or not this is the retracement down to the rising 50 exponential moving average, or whether or not we have it in us to even come on back down and to begin, potentially interacting with these longer term simple moving averages, which are holding up just above again, that 0.382 or 38.2% in anyway, retracement of this 100% range that I've already measured. All right. Either way, okay, looking at this market, we are still in, and it's giving you additional opportunity to, right, continue to accumulate longer term positions on the market, to front run the impending breakout, definitive breakout, the close and the continuation above these all-time highs, most specifically going all the way back to September 2018. And again, most recently into the highs up here in the late period of April, and also most recently as last week. Okay, that's really what you're looking at. This is rather immaterial, even though at the moment it seems material. I understand all the headlines that come out when the market does uncharacteristically sell off. And again, it was largely sort of outside of our control anyway over the weekend, with external forces at play using the Twitter resource. But even having said that, the market itself, it has been overbought for quite some time. Again, we can remain up here, but the good news out of this at the moment, and this little sort of transition or correction, which is good news for us, is that it's really relieving a lot of the overbought, overextended symptoms that were showing up and have been showing up for a number of months on these oscillators. Nothing has changed on our longer term outlook. These markets are still resilient and they're going to higher prices. It's just a matter of, well, is the 50 going to hold, or are we going to see a mad dash down to the, at this point in time anyway, the rising 100 and 200 simple moving averages? But again, on the S&P 500, is there a chance that we come on back down and actually close some of these past retrospective gaps and also retest and tag some of these big Fibonacci retracement areas? Okay, I don't think we are going to get down here. Personally, I don't think we will. I think we're going to more or less turn on a dime, and it's going to set up and continue above these all-time highs, just as unfortunately the majority begin, or at least the loud minority in the majority, actually begin to aggressively short the market. Now is not the time to be doing such a thing. We're not entering a recession. We're still expanding. We're still in a defined macro uptrend. And again, when you think about it, we've moved all the way from about 2,350 on the S&P 500. We were up here getting close to 3,000. I mean, it was only a week or two ago where we were all the way up here at 2,950. Okay, so we'd already moved about 600 points since, again, the 26th of December. And if you look back and if you have a look at this move here, I'm trying to draw out the actual retracements for you. I mean, let me ask you a question. Where are they in the space of about 4 months, 4 complete months? And they're really just not there. This is not a sustainable trend direction over a long period of time. Okay, and it makes sense that we are naturally shaking out that overbought or those overbought readings, but I wouldn't be fearful, and I certainly wouldn't be panicking, thinking that the market itself is very early on in the stage of a bigger retracement, or at least coming back down to this longer term macro primary bullish trend line. We achieved that in December. Very rarely will we do that. At most, looking at that 38.2% retracement. But before we get there, of course, again, we have to close and fall below, again, the 50 EMA, the longer term simple moving averages, and also traditional horizontal support as well. Not to mention, we still have closed gaps or open gaps that need to be closed, which will offer support as well, not only on the S&P 500, but also on the Dow Jones and the NASDAQ as well. You can see back over here, we've got a couple of gaps, and also taking us back to just above 24,500 or 24,600. All right, so that's going to do us when it comes to the market indices. At this particular point in time, a lot of these stocks, interestingly enough, are holding up relatively well. You can see Apple here, it's still setting up that bull flag sort of continuation. Yes, we have definitively closed that open window, but still looking at a 210 entry on this particular stock. Amazon is holding up relatively well. You can see that we're still holding up at this open window. And I mean, considering what the markets have done, that's a little bit of a blessing there on those two individual trades. Boeing Airlines, I mean, I just need to put this out there. Boeing Airlines, I'm still looking at this as a bullish trade. That was meant to be an arrow going up. My mouse tool isn't really working all that well, but we're still looking at it, and I just wanted to make this very clear. I think this is in the process of producing that of a head fake to the downside, which is going to set up a whipsaw, upon which it should sort of reverse very, very quickly And you could see this, all right, come June, back up here at 440. So this is a major warning for Boeing Airlines. I do not like this trade set up to the downside. I've really tried, pardon me, to avoid it by putting this trigger as low as possible. This is not open in my account, all right? This is a counter trend trade. We've spoken about this in depth over the weekend. No counter trend trades when it comes to this current market at the moment, because the dynamic can flip from, again, short-term bearish or pessimistic sentiment, which is what we've experienced Tuesday, Wednesday, into just a continuation of the prevailing trend whereby we don't see prices come back to revisit the current levels that we closed at during today's session. That's the same for individual stocks as well. If the market was in a primary bearish trend, this would be a go-to trade. However, we are still in a defined uptrend. So take it or leave it. My little warning there, it is very important. Baidu is moving closer and closer into earnings. Caterpillar looks to be coming back down to the confluence of rising support. That is going to be an exciting trade when it does slow down and reverse and move back in lockstep with the actual markets. You've got COP trying to make a bottom. This is exactly what we were looking for. We were speaking about, again, a V-bottom type of setup. Although we don't have it yet, who knows, maybe this is the beginning of it. I'm going to keep the entry at 64.85, but I'm happy. Above all else, again, and this is sort of a warning as to the Boeing Airlines type of trade, right? When you got that support area whereby it looks like it's going to crack, but with the sort of experience that people have in the markets, they can warn you as to why you wouldn't want to take that trade. And COP at this particular point is a good illustration, a good example of that. CVX, again, largely going nowhere, but still rather volatile in that we get some pretty interesting daily candlesticks, which are then simply negated the following day. Disney, I think, is reporting after hours at the moment, so we should see a reaction in that particular stock. Google is still basing. Remember, we gave it a little bit of time. We're still looking at this coming back up above 1202. Obviously, the broader market is going to have to help that individual stock at this particular juncture. IBM is sort of flinching with the breakdown at about 137.55. Again, this is still counter trend. Any trade at the moment to the downside, although the market is weak, it is still technically counter trend. So be aware of that. Otherwise, I'm personally still looking at this coming back up to 145. All right, not to confuse you, but I think you are well and truly understand my position on these markets and the direction that you need to be trading and the potential gift right now that the market's offering you. Even if it's not this week or if it plays out this week, who knows, maybe it'll take a couple of weeks, but when it does make that turn, watch out, because you want to have, again, vested interest and an accumulated position in the markets and individual stocks prior to this breakout occurring. To conclude with, Netflix got whacked a little bit yesterday, but it's still holding up above multiple areas of support. So it's doing quite well. A little bit of a short-term double top there, but at the same time, it's come on back down, much like the market's into that rising 50-day exponential moving average. So I just wanted to give you an update there on Netflix too. All in all, though, market is still hanging in there. They're doing well, even though we were expecting, or we were at least priced in for, that of the breakout. It didn't come. Contingencies weren't triggered. There's the Dow Jones Industrial Average. The S&P 500, the hard entries at 2957. That looks like a dash line, which it isn't. The simple reason for that is because of the Fibonacci. This is the Fibonacci range. Remember, I drew it off this candlestick here. You can see it coming up through my screen. I just wanted to warn you that that is not a dash line. If I zoom in and show you, it is a hard default line. You can see the green line going across my screen up here, all the way through here. But anyway, this was a hard re-entry again to add, right, or continue to add on the breakout. What we didn't see was market confirmation up and around these all-time highs. Yes, I understand, and even myself, I've been just nibbling on this retracement, all right, over the past, or really since Tuesday, moving into the close, I started nibbling on it, and more so even today, because again, I'm under the mindset, and so should you, of actually holding, accumulating before the breakout above 2957. This is going to be the cherry on top when it occurs. I think that's a good way of putting it. It's going to be the cherry on top of these markets. If you already have a position, because you'll be profitable on these past historical positions, you can go back and have a look at all of these setups, right? These are all entry positions on the actual DIA, all right? If you choose to trade the DIA, I should really do this on the S&P 500 because that's where most people have those positions. But again, on these pullbacks, right, it's an opportunity for you to put the fear to the side, dance in the face of it, open up a couple, and then again, when it pops, when it continues to pop, when it definitively moves above this area, at least you know you've got a larger position that you've legged into rather intelligently, and then your final trade entry will be up here. Then you can allocate capital into a lot of individual trades as the markets move into their trends. All right, so anyway, that's going to do us as at this Wednesday afternoon market recap. If you have any questions, email me. Understandably, at the moment, I've got a lot of emails really since the close of business on Tuesday that I think I've responded to everyone on Tuesday, and I'm moving through emails during today, but there are still, of course, a few unopened emails. So give me a little bit. I'll let this video render, and I'll get onto that immediately. All the best, everyone. James signing off on behalf of Pivot Point Trading. Goodbye.